My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends. I'm just trying to make some money. My job is not just to entertain, but to educate, to teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Say it ain't so, Salesforce. This longtime market darling, one of the great growth stocks of our era, finished the day down nearly 20% after missing its quarter, cutting its forecast, and just all around laying an egg. It's a breathtaking comeuppance for this cloud king, the first serious shortfall since the Great Recession. It laid the entire market to waste because Salesforce is a component of all three major averages. Hence why the Dow lost 330 points, S&P sank 0.60%, and the Nasdaq tumbled 1.08%.
The House of Pain.
Salesforce is a company that I've championed since it started, well, I guess really since it came public, to the single digits back in 2008. Yeah, I became a believer because I was still at TheStreet.com, which I founded in 1996, and when we used Salesforce, the product, I couldn't believe how much of a lift we got in selling subscriptions. You use Salesforce to get new clients and keep existing clients happy. They predict your clients' behavior, and in an artificially intelligent world that measures value by who has the most data, they are the data keeper. I have never heard of an unsatisfied customer of Salesforce, and I sure wasn't. Never. More important, Salesforce is a distinguished member of what has been the most esteemed cohort in the entire market for almost a generation, and that is enterprise software. This is the kind of software that automates business processes, manages data, manages your company's interactions with customers, handles your enterprise resource planning, and takes care of your business intelligence. In other words, enterprise software automates and digitizes every aspect of your outfit. It's vital if you run a business, which is why there are so many companies that provide enterprise software for many different areas. You want to sell product, you use Salesforce. You want to keep track of the numbers, there are half a dozen companies that can do it for you. You want to help analyze personnel, handle human capital management, deal with supply chain, keep track of the finances. Well, there are another dozen of companies that can help you. You need to be protected from cyber bandits. There are myriad cybersecurity software businesses. You want to onboard people, design a website, keep track of receivables. There's 100 companies that make enterprise software for those spaces, not to mention the hundreds of private enterprise software companies that are just praying to come public. And that's the real issue. A material reason for Salesforce's shortfall. There are so many of these companies, so many publicly traded enterprise software names, we can barely keep track of them all, and they are all nipping at each other's heels, making it much harder to be in this sector than it used to be. Yet these firms keep being pumped out of the venture capital well because it has been the most lucrative part of the entire tech complex since the beginning of time, or at least since the beginning of Microsoft. Everyone in the industry knows that the easiest road to riches is to sell, not to the individual, but to the enterprise. And every young person coming out of any major school that does computer work, they know to go into enterprise software. As Mark Benioff, the CEO of Salesforce, could tell you, these companies cleaned up during COVID. Enterprise after enterprise signed up for the new software subscriptions. It was a heyday for the entire industry.
House of pleasure.
In part because many of these enterprise software tools can help remote workers collaborate. Maybe too much of a heyday. Companies just spent too much on their vendors, ordered too much, apparently much more than they can use or even open. Then something happened that nobody counted on. Generative artificial intelligence and the possibility that there are whole new sections of your company that can be automated. Stuff we couldn't imagine automated before. Are there superfluous people? And if so, how many? Where do we shift them to? Can machines do everything better than humans and for a cheaper price? What can they do better? Do we need to keep hiring if each person may not be as good as the AI co-pilot? Do we need anyone in our call centers? How about accounting? Contracts? Right now, big-time executives in every kind of business, from law firms, accounting firms, to retailers and bankers, they keep pondering, who do they really need? Do they need to hire? Well, who can they let go? With higher interest rates and increasingly uncertain world, why bother bringing in more enterprise software at all? Remember, this is cloud software where you typically pay a subscription per user. Who the heck would pay more when they expect to have fewer people using stuff? How many fewer? We don't know. And that's where we find ourselves right now. You saw it with Salesforce. Then you saw it again tonight with MongoDB, the next generation database management platform. Massively disappointed when reported after the close. Only see its stock annihilated after hours. So far this earnings, we've seen by the same thing, by the way, with Workday. Increasingly, there's concern about ServiceNow, Adobe, two tremendous competitors. I like Adobe's stock's been going down for a while. Meanwhile, many once lowly hardware companies, well, they're finally doing terrific. HP Inc. surging nearly 17% today. There are just too many enterprise software companies that are offering to analyze your data, interrogate your data, shift your data, spread your data, massage your data. And out of nowhere comes the greatest technology game changer in recent history, generative artificial intelligence. Thus, in the stock market, it's tremendous value creators. You can see from just glancing at the chart of NVIDIA. But for those who are selling software that dealt with traditional mode and the traditional model, pre-artificial intelligence, AI kind of feels increasingly like a coin toss. Could be a bonanza if they get fit right into the new paradigm, but it could be the beginning of obsolescence if they can't. Do we need as many auditors if ChatGPT can audit? How about low-level accountants? What do we say to those who create documents, the same documents over and over again, ones in law firms and corporate finance? So suddenly we're in this frightening situation where companies need to say something very different to Salesforce than they've been saying. Certainly something they haven't said maybe in over a decade. They say, Mark, we have to wait and see. We're playing with co-pilots doing remarkable things. Or, Mark, we're thinking of putting our whole outfit in the hands of Dell, which is managing the transition for us, so we can't handle something new right now. Or maybe, perhaps worst of all, Mark, we have no idea how many people we really need, so we have to figure out first, and then meanwhile, business is slowing anyway, so we got to do measured thinking here. We got to take our time. We need many people in on the decision. I'm sorry. We'll have to see you soon. The enterprise software people have had the run of the joint for so long that their stocks have become richly valued, and for good reason. They've had consistently high growth, good profit margins for a long time. Now that growth is threatened like never before, and companies like Salesforce barely saw it coming, or even thought the AI boom would be great for them, everyone's frozen. It turns out maybe it wasn't so good. It might be in the future, but who knows? For now, these enterprise software companies feel like they're rudderless and their stocks are listless, not lifeless. And guess where they're going?
The house of pain.
But companies do engineering software, companies like Cadence that we had on last night, they are in ascendancy. Anything that can make or help make transistors or semiconductors is worth far more than it used to be. A personal computer can soon be an AI-powered personal computer. A robot armed by NVIDIA's Blackwell chips may render vast swaths of the workforce obsolete. No matter what, the halcyon days of enterprise software may have run their course, and unless interest rates come down, I don't see their stocks making a comeback anytime soon. Worse, the fact that these stocks are no longer immune from the business cycle is outright frightening to many people. They're filled with software for what might turn out to be superfluous people, whether in sales or marketing or coding, and you're supposed to pay by the person. Now, I'm not going to write off Salesforce. Too much cash flow, too good, too many smart people. When the smoke clears and the stock works its way down, perhaps under 200, call me a buyer, provided we have requisite number of downgrades that help shake out all the weak hands. Can't have them in there if we're going in. But the bottom line, we may be at the beginning of the great unwind of most enterprise software and the great ascendancy, not of the people picture with Jensen Huang, but of the ultimate clients who use his wares to figure out how best to put their employees to work in a world where AI is changing the entire business landscape. It's changing the guard. And until some of these enterprise software companies drop to the point where they're more reasonably valued, just like the rest of the market, they are a very, very tough stocks to buy. Let's go to Natalie in Tennessee. Natalie.
Booyah, Jim.
Natalie.
My fiance Kyle and I watch every night and are members of the investing club, so thanks for all that you do.
Of course.
Question for you. I've got a small position in Estee Lauder. Is now the time to buy more or hold?
Well, I debated that today when we had our conference call. We had our club meeting at 12 o'clock. And what I said was, until I see something actually good out of the company, I can't keep buying it. It is a horrendous stock. It's the worst stock that we own now. And one of the reasons why it's the worst stock that we own is because that China was bad. But China's inventory has been cleaned out. So I'm not as negative as the street. But there's no doubt about it. EL, I need to see something, anything positive, any sign, even just like maybe like a bottle of Mac. All right, let's go to Daniel in New Jersey, please. Daniel.
Jim, thanks for taking my call.
You're quite welcome.
Jim, I was calling you about Snowflake, SNOW.
Sure.
I'm wondering if the company has been overly damaged from what's going on in the technology sector. Snowflake, as you know, is a very powerful company in the AI space. And just wondering, what do you think of it moving forward?
Well, I think that Snowflake's part of this vast cohort that I'm very worried about that really is. Now, look, they're not an enterprise software so much as a complete cloud system. But I would say that my fears are that that gets brought down like everything else, and the money's going to other sectors and staying away from that one. So it is a collateral damage situation because the quarter, you're absolutely right, was not that bad. But it doesn't really matter, does it? Look, I hate to say it, but we may be seeing the beginning of a larger unwind in the once most loved group of the entire market, enterprise software companies like Salesforce. And now we're seeing the ascendancy of companies using AI to optimize their businesses however they can, and maybe with less enterprise software. Or maybe I'm sorry. Best Buy soared higher after earnings crossed this morning, and with the PC refresh cycle on the horizon, could this charitable trust name continue to be a winner? Don't miss my exclusive with the CEO. Then I first turned in my homework on electricity company Vistra last August, but it's nearly 250% run. Well, is it warranted? I'm breaking down the business again to see if we can keep powering it higher. And the maker of spam and planners reported before the bell today, so I'm checking in with Hormel CEO after a slower quarter brought the stock down hard. Stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
We keep hearing that retail's struggling right now, that consumers are overstretched, but certain individual chains keep putting up great numbers. Take Best Buy, which we recently bought for the charitable trust, making me look like a genius, I know, because the stock shot up 13% today in response to the quarter. Of course, look, the actual numbers Best Buy reported this morning were not perfect. Softer revenue, softer same-store sales, offset by really good cost controls, allowed the company to deliver a 13-cent earnings beat off a $1.07 basis. Management's guidance for the current quarter was okay, slightly lower than expected same-store sales guidance, but I saw things that I liked. But, and this is a big but, on the conference call, Best Buy told us that May trends have significantly improved from previous months, reiterate that the year should be getting better as it goes on, in part thanks to, yes, of course, the new generation of AI-fueled personal computers, because you're going to get one there and so am I. And that's why even though the stock initially traded lower after results, which I knew was wrong, it only finished the day up big. I think it's got more upside. Don't take it from me, though. Let's dig deeper with Corey Barry, the CEO of Best Buy, to learn more. Ms. Barry, welcome back to Mad Money.
Thank you so much for having me, Jim.
You're kidding, Corey. I'm thrilled that you're here because you are going to be the first person who's going to explain to me how AI actually is helping your business and how you can make AI help my business, because I don't know how the heck to use it.
One of the most ironic things about AI is that it actually is the most human of technologies. It takes things that used to be really human in nature and then allows us the ability to recreate those things at scale. So we're using it in our business. Like, I'll give you a great example. Right now, you can go out to our website and you can look at reviews that are left by customers. Those reviews are now collected and they're summarized, and then you can sort by those reviews. Just like if I was to talk to a blue shirt, I would say, help me understand what people like or don't like about this. Now you can do that digitally across all of our product categories. And so the way that we're going to start to use AI is to take these devices that can be like cold and electronic, and actually it will start to be a real human counterpart to what you do day in and day out.
Now, this also means to me that there are two different companies that I'm thinking about getting my AI PC, Dell and Hewlett-Packard. I've got to figure out which ones I want. So what I will do is go to Best Buy, because I don't know how it works, and I won't pit them against each other, but I'll say, you show me one, you show me the other. I believe that, will that not be the way that most people are going to get in what's going to be the biggest refresh cycle in history?
I think what is one of our superpowers is the fact that we are very agnostic to the technology. We are focused on the consumer. And so a lot of this is, what is your preference? What matters to you? Does battery life matter the most to you? Does overheating or using it really frequently matter the most to you? Does form factor, lit up keys, what matters to you as a customer? And so our job is to understand the wide assortment. We're going to have 40 different SKUs at launch. 40% of those will be exclusive to Best Buy, which is the largest in a retail channel. And our ability will be, we don't care which one you like the best, Jim. We just want to help you find the one that solves your particular needs.
Now, I don't mean to slight everything else. It's just that I know we're all going to go. I mean, for instance, I follow when you said the Samsung phone is doing great. But why? Because it also has great AI.
Well, and what's interesting is it's not just about the AI, it's about how do you bring the AI to life. One of the things that our teams do really well is they work way upstream with our vendors because we understand what people are actually looking for in the products. And we've partnered with Microsoft, we've partnered with Qualcomm, with others, so that we can help influence what actually comes to market. And then we can talk about it in a really human way. It's one thing to say this phone has AI on it. It's another to say, I can circle that lamp and it will tell me immediately where to go buy that lamp. And we're trying to help bring the story to life, no matter who the vendor partner is.
Now, again, I have the biggest screen that you sold. I got that, and you guys put it up for me. And I think others are, too, because movies come so fast to the home. But it was a business that you had to finance. I want to know if rates came down, obviously things would just go so much better. You've got that great private credit card. But people are worried about high price of money. If that came down, would we see many more of those larger appliances go?
I mean, I think rates are always going to be helpful, not just in the credit side of things, but also obviously in the home buying and remodeling side of the business as well. So as rates go down, I think you just see a consumer who tends to have a more positive attitude toward those bigger ticket purchases. And so obviously that's helpful over time. But what we're trying to stay focused on right now is no matter who the consumer is in their current situation, how can we help them, whether that's financing, whether that's lease to own, whether that's buy now, pay later. We have many options that I think can help across a consumer demographic.
Okay, let's go back to PCs for a second. Do you think that these big companies, which don't have their own retail outlets, frankly, will be driving traffic towards you? And then when I get there, will there be people really well educated from Dell and Hewlett, HP, who will be able to tell me these differences?
Yeah, so I think that what everyone is going to look to do is find the right outlets where the consumer can find the most information. And we are, as you can imagine, arming ourselves on every angle to be the single best place to come experience this across the assortment. So you're going to see physical demos of all the products that you can touch and feel and play with. And importantly, you're going to see us certify and have zoned specialized associates in hundreds of our stores. And we know when we certify our employees, they have a better customer experience that tends to translate into a more fulsome purchase. We will have Geek Squad agents who are certified. We will literally have thousands of employees who are certified in the next generation of AI-enabled computing so that we can try to bring this to life for you in a way that really resonates.
Okay, it's not clear for me yet exactly what the timeline should be. If I want my new PC, when will I go to be able to get it, be sure you have it, and walk out with it?
The actual products from Microsoft will be available for purchase on June 18th, but we will have some demos in our stores available to play with, touch, feel, and start to look at even before that. And pre-orders are actually available now digitally, and those will be fulfilled in about the middle of June.
In the meantime, how's the Apple product selling?
This has been another bright spot for us, and I think it underscores the thesis that we have had about our business. We index best when there is innovation in the marketplace, because that is what we bring to life in partnership with our vendors better than anyone else. And we're seeing some strength in those new tablets, in the Pro and in the Air. And importantly, Jim, what that allows as well is some of the older generations of tablets, they come down in price as you have some of the new generations, which means you have value across the spectrum for anyone who's just looking for that new tablet. But definitely part of what we saw in that uptick in May from the trends we were seeing prior is some strength in that tablet category as people gravitate toward these beautiful new devices.
Absolutely. Now, look, one last thing. I know you're busy. I've got a huge schedule. June 16th, I know that's only a few weeks away. Will you let us go to one of your stores in New York City and sell us? And we'll all buy them. And we do it on film because I would love for you to be there.
Jim, I would be happy to spend some time with you and the team, but let me be clear. It won't be me selling you. We have an army of blue shirts that are out there ready and waiting to try to be helpful, and they are super excited to see you.
Then we'll rely on them, and you can show us around the store. How about that?
That sounds perfect.
Fantastic. That's Corey Barry. What a quarter. CEO of Best Buy BBY. Yes, large position for the Chapel Trust. You can read all about it. We talked about it extensively today in our conference call. Mad Money's back there for the break.
Coming up, Cramer doesn't stay slumped for long. He's done his homework. Is the heat from this energy play flashing V for victory? Keep it here.
couple weeks ago, I got a call from Russell in Texas. Wanted to know about Vistra, a diversified utility that's rallied a stupendous 354% just since the end of 2022. We actually got a call about this one before. It even turned into a homework assignment. But while I was generally positive on the story, I clearly wasn't bullish enough. Nobody's been bullish enough on this one. So what in the world is driving this Vistra's incredible move? And more importantly, has it got more room to run? First, let me give you some background on the story. Vistra was originally known as Texas Competitive Energy Holdings, which emerged from bankruptcy of Energy Future Holdings back in 2016. Then they changed their name to Vistra Energy before rebranding as just Vistra a few years ago. Vistra's intriguing. This company used to be mainly an electric power distributor operator in Texas, the Northeast, the Mid-Atlantic, the Midwest, and California. But that doesn't explain how the stock could quadruple in less than a year and a half. What's really got people excited about Vistra is its power generation business. This company's now become the largest competitive power generator in our whole country. They produce enough energy to power 20 million homes. Buy! More important, while Vistra uses all kinds of power sources, there's a renewable kicker here with solar generation, battery technology to store solar, along with nuclear. Regular viewers know I love nuclear power because it's the only serious way for companies that talk about going zero carbon to actually achieve that at scale. Earlier this year, Vistra completed the acquisition of Energy Harbor, giving them the nation's second largest fleet of competitive nuclear power plants, along with many more solar and battery storage assets. Now, like I mentioned before, when we covered this stock late last summer, we just weren't bullish enough. While I certainly wasn't negative on Vistra and even issued an open invitation for Vistra's management to come on the show, in the end, I said I'd rather stick with Constellation Energy, the independent power producer that's the closest you can get to a pure play on nukes. Since then, Constellation's up 110%. But it's got nothing on Vistra, up 251% over the same period. So, mea culpa, I got that wrong.
That was easy.
But what exactly did I miss? What couldn't I see Vistra's incredible move coming? It's my job. Well, first off, even though I knew about their pending Energy Harbor acquisition and told you I liked it, I still didn't appreciate just how well-timed the deal would be. It generated a massive amount of excitement for this stock, Vistra. Now, that was a $3 billion cash and stock deal, announced on March 6th of 2023, closed on March 1st of this year. It matters because it gave Vistra 3 additional nuclear plants in Pennsylvania and Ohio. Previously, they only had 1. Crucially, this happened just as Wall Street was falling in love with nuclear power all over again, as businesses increasingly realized that nukes are the only reliable source of carbon-free energy. And by the way, it is a tragedy that the environmental movement spent decades fighting against nuclear power because, admittedly, of the intractable issue of nuclear waste, because nuclear power is really the only way to beat global warming on any reasonable timescale. In addition to going increasingly positive on nukes, over the past year and a half, Wall Street's also gotten a lot more bullish on the independent power producer business. Why? It basically goes back to the AI boom. Right now, we're in the midst of an enormous AI infrastructure build-out, meaning tons of data centers that practically devour electricity. With all these data centers, companies are desperate for additional energy capacity because traditional regulated utilities simply wouldn't be able to support all that demand. Now, remember, electricity demand is now growing by about 5% a year in this country after not growing at all for many, many years. And that's where the independent power producers come in, especially the ones that can provide clean energy like Vistra or Constellation Energy. Buy! And the thing is, there really aren't that many independent power producers to begin with, and even fewer publicly traded ones. Aside from those two, there's NRG Energy, another stock that's doubled in under a year, and not much else. By the way, NRG Energy, I like that one too. For Vistra specifically, that AI data center power demand story is a huge driver of the stock's strength. But it's not the only secular growth story out there. The other part of the equation, Vistra's got a major presence in Texas. And in Texas, they're electrifying the oil and gas business, especially in the oil-rich Permian Basin. And that's why Vistra's stock has been such a juggernaut. Everything else flows from there. I could throw in more details, like the fact that the company reported a blowout, unbelievable quarter earlier this month, or if the stock was out of the S&P 500 earlier this month, taking the spot when it's open when Pioneer Nat was bought by Exxon. But in the end, it's about data center-driven demand for energy, especially clean energy, and the increasing electrification of those oil fields in the Permian Basin. So what are we supposed to do with Vistra, the stock at these levels? That's a tougher call. Obviously, with the thing up 350% since the end of 2022, including 173% gain year to date, it feels a little precarious up here. But you know what? When we looked at Vistra's valuation compared to Constellation Energy, again, the closest comparison, you can see that Vistra is substantially cheaper than Constellation. Vistra has an enterprise multiple, that's the enterprise value divided by the earnings before interest, taxes, depreciation, and amortization, of just 11. This is the way you do the compare. 11 based on this year's estimates, while Constellation's enterprise multiple stands at over 18. We like to use EBITDA with utilities because they're increasingly capital-intensive businesses, lots of debt that need to take big depreciation charges for the machinery. And on this metric, I mean, Vistra, it just looks like an out-and-out bargain. Buy. That said, if you made me choose between the two, you know what? I'd still stick with Constellation Energy, despite the valuation disparity, simply because I'm more familiar with the story after following it for longer. I've spoken to the management team a few times since I started pounding the table on the stock in the early 2022. More important, Constellation is much closer on being a pure play on nuclear energy, which I really care for, although Vistra is now much more nuclear focused than it was when we first covered it last year because of that Energy Harbor deal. Finally, Constellation's gradual move higher looks more sustainable than the parabolic move we've seen in Vistra. Then again, Vistra is still cheaper. Here's the great news that you don't got to choose. You got my busted to buy either one of them. The AI-driven electricity boom is just too good to ignore. Ideally, you wait for a pullback in these incredible hot stocks before starting a position. But I'm certainly not going to tell you that the rallies are over. They're both riding a theme that should last through the end of the decade or longer. Let me give you the bottom line here. We weren't bullish enough on Vistra. We just weren't. It's an excellent story, gives you exposure to one of the best themes in the market right now, which is why you definitely should think about owning either Vistra or Constellation. I know after working on this piece, I am thinking about the same thing for my charitable trust, which you can follow by joining the CNBC Investing Club. And I can't believe I missed it. Darn it all. It was right in front of me the whole time. Let's go to Len in Texas. Len.
Jim, thanks for taking my call. Long-time listener, first-time caller. My
Excellent.
question is about ConocoPhillips with their recent announcement of acquiring Marathon Oil. How will this impact the relationship with the other Marathon-related entities? Specifically, you have MPC and MPLX. One handles the downstream, one handles the midstream, and I'm just concerned about, I guess, the dividends that MPLX has been offering and paying almost 9% for a long time. Are these in jeopardy, or do you still recommend these?
I like them. I like them. MPLX, I like, and my understanding is they're separate. If I find otherwise, I will certainly tell you. I think MPLX is a terrific situation, and I don't want to back away from it. Thank you for that call. Let's go to Jeff in New York. Jeff.
Hello, Mr. Cramer. This is Jeff from Sodus, New York, on the south shore of Lake Ontario.
Perfect.
Hey, with summer officially starting this past weekend, there's no better place to spend it than Rochester and the Finger Lakes area. You and your wife should come up for a visit sometime.
Thinking of it. Actually going to Saratoga. I know it's a little too far east. I'm going to Saratoga in a couple weeks. I should go west, young man. Help me.
You out here and watch those ponies while you're in Saratoga. But, Mr. Cramer, thanks to all the knowledge that you provided me over the years, my mom thinks I'm a good investor, and she asked me to manage her small IRA. She's just recently retired, and there's a stock in her portfolio that's been giving me trouble. Should I continue to hold or cut my losses in Boeing?
Oh, it's the toughest stock in the world. Oh, my. I'm not kidding. I mean, this is one I have done it right. I've done it wrong. I've done it right. I've done it wrong. I am going to say that it's down 33% for the year, and you can continue to own it. But please don't buy any more. And thank you for thinking that I could actually do it. Good job on Boeing, because that's the toughest stock on the whole S&P 500. Thank you. All right, look, I try and wait for a pullback in this Vistra before you pull the trigger. But I think the story's fantastic. Gives you exposure to one of the hottest themes in the market right now. Cheap power that's clean. Much more money, include my exclusive with Hormel. After today's post-earnings dip, can we expect a bounce back in demand for this packaged food player? I got the CEO. Then with another potential drug approval on deck, I'm diving into what I think Eli Lilly could blow past estimates and keep trending higher. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. All right, what on earth are we supposed to do with the stock of Hormel Foods? The protein-oriented packaged food company behind Spam, Applegate, Skippy Peanut Butter, Planters Peanuts, among other major brands. This morning, Hormel reported a seemingly mixed quarter. It was a small revenue miss, a small earnings beat. Management even raising the low end of their full-year earnings forecast. Yet somehow the stock got obliterated. It's down nearly 10%. Why? I don't know. Management made some comments about softness in certain center of the store items. So is this an overreaction? Maybe a buying opportunity? Let's check in with Jim Sneed, the chairman, president, and CEO of Hormel Foods, to get a better sense of what happened today. Mr. Sneed, welcome back to Mad Money.
Thanks, Jim. Great to be with you again.
Okay, so Jim, I went over all your hero brands, all the things that we all know and love, and frankly, they all did great. I'm talking about looking at Skippy, at Spam. Spam did great. Namesake brand. Applegate, which we love, did great. So the mystery for me is what made it so people feel either that you're not doing great or knocked down the numbers to the point that those major brands were not didn't get to shine.
Yeah, well, Jim, I mean, we had a really strong first half, consecutive quarters of better than expected results. And when we look across our segments and our brands, really strong performance in retail brands, just like you said, Spam, Skippy, Applegate, all performed really well. Our food service business continues to outperform what's happening in the industry. Really good recovery in our international business, probably ahead of schedule from what we thought. So, I mean, as we think about what we said today about the first half of the year, and then, as you said, raising the low end of the guidance for the back half of the year, we feel really good about the condition of the business and where we're headed.
All right, so maybe we just go over some of these things that, like, say, Piper Sandler mentioned, turkey price headwinds persist. I know that Jennie-O turkey did well, but whole turkeys did not?
Yeah, so Jim, there's a couple of dynamics happening in the business, especially on the retail side. And so the first part that I think is important is when you think about scanner data, right? That's what's reported out of retail outlets. Our scanner data was really, really strong. And then more on the commodity side of the business, we do have an element of whole turkeys. And that commodity market has decreased substantially. And so that's outside of our control, right? We're at the mercy of what the market does. And I think it's important to know that both of those things can be true at the same time. We can have great scanner data strength with our brands while we're still battling the top line headwind of the turkey markets. But I really don't think that takes away from strong first half performance and what we think we're going to be able to get done in the back half of the year.
Well, are the brands that are, say, center stored, some of the canned foods, are you getting any price pushback from, say, a Walmart? Just saying, listen, we're not as interested in some of these older brands?
Yeah. Jim, our brands have got great history. They're great legacy brands, and they still resonate with consumers. We already mentioned them, but Skippy had a really strong first half of the year. Spam, really strong first half of the year. Now, are there pockets within the center of the store that are underperforming? Absolutely. And that's on us, right? That's what our team has got to do to make sure, whether it's promotional activity, price pack architecture, all the things that we do to make sure that we're making them more relevant for the consumer. But from a pricing perspective, that's dealing with our customers. Passing along pricing is never easy. But we always know that when we go to them, we're going to have good, solid rationale for why we do need to take pricing.
Okay, so maybe what confused people was the Planters facility interruption, which obviously will not be repeated. That was one time, but it did hurt earnings.
Yeah, so what we talked about there, Jim, is we did have a supply disruption, and I do want to make the comment that, food safety is paramount. And so we made sure that we did all the right things. We shut down the plant for about 5 weeks, and we're back up and running. And so the impact of that is going to be in our Q3 performance. We said about 3 cents per share. But even in spite of that, right, we said for the full year, we're going to raise the low end of the guidance. So it's going to have an impact. And if that hadn't happened, we'd be talking even more positively about our performance.
Of course. Now, Jim, this morning I was watching the CEO of Nestle. He's a very smart man. And he was saying, look, we are really seeing an impact from these GLP-1s. He was very forward about it. And he said, we got to have more protein. That's what we're going to do. We're going to put more protein in the lineup. I look at your lineup, and your lineup resonates with protein. So when are you able to take offense on that and say, listen, we've got the protein that you want, America, or else you're going to be frail if you're using or augmenting with these different drugs?
Yeah, I mean, that you and I talked about that last quarter, and this is something that's front and center for us, Jim, is our portfolio lends itself to the opportunity that you're talking about. And so we really need to think about what day parts do we want to own? What brands, what products really resonate with those consumers who are on the GLP-1 drugs? We know there's an opportunity, and it's on us now to do just what you said. We have to go on the offensive, because whether we think about Justin's nut butter, Skippy peanut butter, any of our snacking items, Planters, all of those fit the criteria for what those consumers are going to be looking for. So we know the opportunity, a little bit of work to do, and we are going to go on the offensive.
All right, last thing that's so important for our viewers. They'll see the stock down. The first thing you say is, well, how about that dividend? Your cash flow was extraordinary. Dividend, if anything, you'll have no problem. The board will probably, if they have to, be happy to raise it, as usual.
Yeah, I think there's a couple of things, right? We said strong first half performance, incredible cash flow, improved margins. I mean, there's a lot to like about the performance and the business, and we are a dividend aristocrat, and we're going to stay that way.
All right, that's terrific, Jim. Thank you for explaining everything to us. It is time to play offense. You've got the right lineup for a world where people are going to be taking these drugs, and I would rather be in your shoes than Nestle's at this very moment. Jim Snead, President, Chair, and CEO of Hormel. Thank you, Jim. Good to see you.
Thanks for having us, Jim.
Absolutely. Mad Money back every break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. It's time for the lightning round. It's time for the polls. One never seen it. It's about something. Because talk with this. My step for this. But you play this up. And then the lightning round is over. Are you ready? Skeet that. Time for the lightning round comes. Let's start with John in Illinois. John.
Hey, keep up the good work, Jim. I'm watching the Bitcoin miners dip, and I want to get your opinion on Riot platforms.
No, look, if we're going to be in that, we're just going to go buy Bitcoin or go buy Ethereum. Either one is fine with me. Let's go to John in Virginia. John.
Hi, Jim. Thanks for taking my call. The stock I'm calling about has risen 90% over the past 12 months, but there have been 19 insider sales and no insider purchases during this period.
Right.
And the president has sold 40% of his own stock.
Okay.
Since I purchased the stock, my shares have almost tripled in value.
Well
My
played.
question is, how much of my stock should I sell?
And this is KLA?
KLA.
All right, it's tripled. I want you to take out half. Okay, take half and let the rest run. Then you'll be in great shape. Can't lose your money. And I think that'll be terrific. I do like KLA, but it's up a great deal. Let's go to Brendan in New Jersey. Brendan.
Hey, Jim. So you seem like an animal guy. I saw on your X page you got 2 new dogs. They look very cute. So I was wondering what you think about Beyond Meat as, alternative meat stock.
No, don't want to own that. Way too risky. I'd rather have you own Hormel down here. I think it's a better play. Let's go to Kathy in California. Kathy. Kathy?
Yes?
Go ahead. You're up.
Oh, okay. How are you, Jim?
I'm good, Kathy. How about you?
Okay. I'm a longtime follower from California.
Okay.
I just want to get your opinion on what do you think and your take on AMC, Advanced Micro Device.
Okay, Advanced Micro. Right now, tech's going to be weak for a couple of days because there's a lot of stocks for sale. I think AMD under 150 would be terrific. It does not have what NVIDIA has. It's real good, but it doesn't have what NVIDIA has. Let's go to John in New York. John.
Jim, John from South Shore, Long Island.
Oh, good to have you on the show, John. What's up?
Summer is coming, Jim. Hopefully lots of sunny days ahead.
Okay.
My question is the future bright for Warby Parker?
You know what? I'm thinking about what Steve Yalof told me about from Tanger. He was saying this is quite a triumph to get these guys in the store. A lot of people feel it's a great thing to have them in the mall. So I'm going to say, yeah, it's okay. It's all right to buy. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
Coming up, this update from Goldman Sachs could impact a big pharma favorite. A peek into Eli Lilly's pipeline when Mad Money returns.
Typically, there are two ways for a stock to go higher. First, the animal spirits of the market, meaning when investors get excited and become willing to pay up purely in order to chase momentum. They can't resist buying higher in these situations, even when nothing actually happened. I don't like that way. Too emotional, no rigor. And then there are situations where the numbers, specifically the earnings estimates, just keep going higher and higher. When the estimates go up, the stock's naturally worth more. So it makes perfect sense to pay up. The stock of Eli Lilly, one of the greatest performers of the year, falls distinctly in the second camp. It just won't quit because the numbers keep getting better and better and better as they find more uses for their incredible GLP-1 drugs, originally for diabetes, then weight loss, and now possibly many other applications, including increasingly life-saving ones. This morning, Goldman Sachs updated their estimates for global obesity drug sales. Instead of $100 billion by 2030, they now think it's going to be $130 billion. Maybe they watched the new South Park special, The End of Obesity. In 2024, Goldman estimates that Lilly's anti-obesity revenues could hit $5.3 billion, up from their previous estimate of $4.7 billion. Hey, how about 2030? They think it could grow to $56.6 billion rather than the previous estimate of $49.7 billion. Hey, by the way, the entire company only had $34 billion in sales last year. And so that is extraordinary. I think Goldman's estimates will turn out to be too low. I believe these drugs, which started out as diabetes drugs and then became weight loss drugs, will probably go down as the greatest cardio treatments, starting with dramatic declines in intractable blood pressure for even the toughest cases. That could be remarkable for people who have fatty liver disease, too, which is often fatal. With each new indication, Lilly stock should go higher because the estimates will go higher. With each new country it's approved in, and for each new use case, the stock will go higher because the estimates will go higher. It's hard to get a handle on what these GLP-1 drugs can do. For example, I don't expect a clinical trial, but I believe it could be the ultimate weapon against alcoholism or against heavy drinking because it kills your cravings for hard liquor. And there are few things less than healthy than being a heavy drinker. There are millions upon millions of heavy drinkers. All of these indications are huge, and I reiterate that they're not currently reflected in the estimates. The only gating factor, as one of our astute investing club members pointed out today, is that you can't get at the product. There's not enough to go around. Eli Lilly's furiously trying to put plants up around the globe to make the stuff, but it can't take to make them fast enough, and they ain't rushing it. Now, that's not all Lilly is going for. It also has an anti-dementia drug called donanemab that could potentially be approved 11 days from now, when the FDA Advisory Committee for donanemab is scheduled. Talk about something not being in the numbers. I don't think many owners of Lilly are even thinking about this drug that could be revolutionary for Alzheimer's. If the dementia drug's approved, the estimates will get another boost, and then you'll see Lilly stock trade even higher. I know there are many doubters in the GLP-1 drug class. I heard that people stop taking them after a time because they don't like injecting themselves. Some are worried about frailty because the drug takes a huge amount of body fat off, but it also takes muscle. You need to boost protein intake to try to balance things out. People don't want to do that either, and they like the taste of food. Not anymore. No matter, these drugs are lifesavers, and their use is saving. It's just still in its infancy, frankly. When Goldman predicts that GLP-1s will do $130 billion in sales in 2030, I'm betting that estimate is way, way too low. And when they adjust their numbers higher, again, what do you think will happen? Yep, Lilly stock will go higher too. I like to say, there's always a bull market somewhere. I promise I'd fight just for you right here, Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.